Today we're going to start Chapter 8, Stocks and Stock Valuation. This is to continue our discussion from Chapter 7, where we introduced bonds and bond valuation. So Chapter 8 now is about stocks. In the last chapter, I gave you a link to a video from Khan Academy which talks about bonds. So here's another link. It takes you to another video from Khan Academy about the difference between bonds and stocks. So I would recommend you to go check out that video. So, common stocks. We say equity securities represent ownership in a corporation. So if you hold, say, 100 shares of Apple stock, you have a little bit ownership. You are one of the owners of the company. We also say common stockholders are residual claimants, which means they have a claim on the cash flows only after all other claimants, such as employees, suppliers, debt holders, and government, have been paid. So think of the stockholders, common stockholders, as the last in line to be able to get money from the company. You have to wait until everybody else get their pay. In other words, stockholders get the leftovers, or say the residuals. This does not necessarily mean that stockholders will get the least amount. Actually, a lot of times they will get the most or highest amount of cash flows from the company. So how much stockholders can get eventually determine the value or how valuable the company's stock can be. So the market value of a company's common stock really depends on many factors that would affect the company's performance and in turn affect how much stockholders can get out of the company. So all those factors would include company's profitability and cash flows, again, how much money the company can make, company's growth potential, which affects how much money they can make in the future, market interest rate, overall market condition. All these factors, they can affect how much money the company can make in the future, and in turn how much investors, stockholders, can get out of the company. So that is fundamentally how much the stock price is based on. As we all know, stocks are traded in the stock market. Why do we need stock market or those stock exchanges? The key word here is the liquidity. We need a healthy, well-functioning stock exchange to provide liquidity for the investors. With the liquidity, investors, or say the owners of common stocks, they can sell the stocks and convert the stocks into cash at any time without too much difficulty, and that gives them confidence to invest in the stock market. To understand the importance of the liquidity provided by the stock market, just think about this. If you have money and you want to invest in 1,000 shares of Google stock. Google stock is traded around $1,000 per share now, so 1,000 shares, that's about $1 million investment. Google stocks by now are considered as pretty good investment. But if you are told that once you buy them, you have to hold them for at least 10 years, and within the 10 years, you cannot sell them unless you pay a 20% penalty. Would you still be willing to buy the stocks, even if it's Google? Maybe your answer will be no. So you understand that investors generally would need liquidity because they want to know that they can sell the stocks when they want to sell. So if you see this 10-year lock-in period and this 20% penalty, you will hesitate. So when you hesitate, it's because you understand that you need liquidity, and you need a market that provides liquidity for you to get into the market when you want to and get out of the market when you want to as well. When we talk about stock markets, the place where buyers and sellers meet and do the transactions, the first thing that usually comes to mind is either the NYSE, New York Stock Exchange, or the NASDAQ. These two stock exchanges, they actually account for the trading of a major portion of equities in North America and also worldwide. NYSE, the New York Stock Exchange, is the largest equity-based exchange in the world, and NASDAQ is another very important stock exchange. These two actually are very different in the way they operate and also in the types of equities or say companies that are listed on them and traded on them. So I summarize the differences between the NYSE and the NASDAQ from the following perspectives. First of all, in terms of location, NYSE has a physical place with trading floors in New York City. So here's a picture of the NYSE building. It's located in New York City, of course, and you can imagine a lot of transactions are happening inside of this building. And inside, the trading floor looks like this. You can see all those stations with a lot of the specialists and brokers running around. And you don't see that for the NASDAQ because NASDAQ is operated on a telecommunication network. There is no physical trading floor for the NASDAQ market. And then how the transaction happen in those two markets are also different. NYSE operates on a so-called auction market. So in the auction market, buyers and sellers, they typically buy and sell between each other, and there is an auction, which means the highest bidding price will be matched with the lowest asking price. If you remember in the last chapter, we talked about the bid price and ask price. So the bid price is the price at which one wants to buy, and the ask price is the price one wants to sell. So the NYSE market actually provides this matching to match the buyers and sellers together. The NASDAQ is actually what we call as a dealer's market. In the dealer's market, you have dealers or say the market makers. So buyers and sellers, they are not buy from or sell to each other. Instead, they go through the dealers. So if you want to buy, you buy from the dealer, and if you want to sell, you sell to the dealer. So that's why we say on NASDAQ, the dealers or say the market makers, they transact with the buyers and sellers to keep the flow of trading going. But on NYSE, there are no dealers or market makers. Instead, there are so-called specialists. So the specialists are in charge of matching up the buyers and sellers. And that is just to facilitate the trades instead of trading directly with the buyers or the sellers. Either way, the duty of both the dealers or say the market makers and the specialists is to ensure the smooth and orderly transaction for their clients in the market. One thing people have noticed about the difference between NYSE and the NASDAQ is that somehow NASDAQ is typically known as a high-tech market because the companies that choose to be listed on NASDAQ and trade in NASDAQ, they are usually the high-tech companies like Google, Apple, Facebook. They are relatively young and new and in the high-tech industry, and also the stocks can be more volatile and also growth-oriented. The companies on NYSE, on the other hand, they are usually more well-established. So they include those so-called blue chip companies, and usually these stocks are considered to be more stable and less growth-oriented. So when we look at like companies like Ford, AT&T, P&G, those are also very well-known companies, and they are listed in NYSE. So again, perception-wise, when we think of NASDAQ, we think of a market full of those high-tech companies, new companies, young companies. And when we think of NYSE, we usually think about more stable, well-established companies. We also have to be aware that the stock exchanges, they are changing very rapidly. So we just talked about NASDAQ is based on an electronic network, and NYSE has a physical building or physical location. However, a lot of the transactions in NYSE, they nowadays are also traded on the electronics or computerized system. Well, it's just a technology these days, right? So if you watch some old movies about finance or Wall Street, you may remember seeing those people waving their hands and yelling on the trading floor. These days, you don't see that much because a lot of transactions are actually done electronically. Also, stock exchanges, they are merging, they are becoming larger, usually with international focus, pretty much driven by competition because they need to get bigger and be more competitive. Now, let's talk about tracking the stock markets because every day there are so many stocks traded in the market. Some are going up, some are going down. And if we look at the overall market, how do we get some sense of whether the overall market is moving up or down and by how much? Practically, we cannot look at all the stocks in the market. That's why we look at different stock indices to help us understand the overall stock movements. There are lots of stock indices tracking different segments of the stock market. So as you see here, we have Dow, we have S&P 500, and we have NASDAQ. We'll talk about these three in this lecture. We also have other stock indices, such as the Russell 2000. Those are in the US market. Now you can imagine in the European market, in the Asian market, different countries, they have different stock indices as well. So in the US market, three most recognized indices are the Dow Jones Industrial Average, S&P 500, that's the Standard & Poor's 500 index, and then we also have the NASDAQ Composite Index. So we'll start with the Dow Jones Industrial Average. It's also called the Dow. The Dow was invented in 1896, and back then it consisted of 12 companies, 12 stocks. Now it has 30 companies, and those 30 companies generally represent 30% of the total US stock value. So you can imagine these are 30 very big, very successful companies. If you look at this website, it shows you the 30 companies that are included in the Dow Index. So these are big names such as Apple, Coca-Cola, Home Depot. Another thing about the Dow is a so-called price-weighted average. That means you start the computation of the Dow by adding up the prices of each of these stocks and divide them by total number of stocks, which is 30 here. And of course, that's just a starting point. As you see, the total Dow value like today is around almost 27,000. So there is certain mechanism or equation to convert the price average into the number that's over 26,000 here. But that's beyond the scope of this class. At this point, just be aware that the idea behind the Dow Index calculation is the so-called price-weighted average. Now let's look at S&P 500. The S&P 500 index was created in 1957. People realized when you look at Dow, 30 companies, that's just not enough to represent the whole stock market. So they tried to come up with a more comprehensive index to represent all 10 sectors of the economy. Actually, now, today, it's not just 10 sectors. We're talking about 11 sectors. For example, the consumer discretionary or consumer staples, energy sector, financial sector, healthcare sector, and technology sector. So these are the list of the 11 sectors now in the economy, and each sector well represented in the S&P 500 index. Because of the fact that the S&P 500 index use a list of about 500 companies instead of 30 companies, it's considered to be superior to the Dow just because of the wider coverage and also the way it is calculated. So what is the way it is calculated? It's actually using the so-called market capitalization to compute the index other than just using the stock prices. So remember, Dow was so-called price-weighted average. Here, we don't just add up the prices of the 500 stocks and divide it by 500. Instead, we add up the market value of all these stocks. And that is more reasonable than the price-weighted average because the market value of the company depends on not just the stock price, but also the number of stocks outstanding in the market. As you see, in the past 3 years, from 2016 to 2019, the stock market has grown substantially. We did see a drop in the market by the end of 2018, but soon after that, the market recovered and kept growing. The last one we want to talk about here is the Nasdaq Composite Index, and this one was launched in 1971, so it's relatively newer than the Dow or the S&P 500. If you recall, we just talked about how the Nasdaq market is considered as the market for the high-tech new companies. So consistently, the Nasdaq Composite Index is considered a measure of the performance of the technology sector, or say the so-called new economy. The Nasdaq Composite Index is also using a so-called market cap weighted average, which means we don't just sum up the prices. Instead, we look at individual stocks according to the total market cap and then calculate the market cap weighted average. So now we'll just use a simple example to explain how we look at the stock index to understand the movement, or say the performance in the market. For example, back in May 7th of 2014, S&P 500 closed at 1878.21, and that was 10.49 points higher than May 6th, 1 day before. So how much is the return in percentage of the stock market that day? Well, if 1878.21 was 10.49 points higher than the 1 day before, that means 1 day before the S&P 500 was at the level of 1867, which is 1878.21 minus the 10.49 points. So 1867.72 was where S&P 500 was at on May 6th. So then the return on May 7th is how much the market has moved up, the 10.49 points over the base level, which is May 6th level. So that's about a 0.56%. So if you actually did look at the market that day, you will see something like this. It's telling you for S&P 500, current level on May 7th is 1878.21. So if you see green, that means it's higher than the day before, and it's 10.49 points higher, and that represents a 0.56% growth in the market in 1 day, and that 0.56 is calculated this way.